U.S. Treasury Secretary Scott Bessent said he sees a de-escalation in the trade war with China in the very near term, also calling the tariff fight between Washington and Beijing unsustainable. He was speaking at a private investor summit in Washington hosted by JP Morgan Chase on the sidelines of the World Bank meetings this week. The International Monetary Fund, that's the IMF, yesterday also cut its economic growth forecast for 2025, adding that an increase in tariffs and uncertainty implies a significant slowdown in its latest global outlook. The IMF forecasts global growth by 2.8% this year, down from its previous forecast of 3.3%. A lot of questions to be answered. For example, just as Bessent said, why has China and India not been told to reduce their high tariffs if indeed high tariffs are bad? But also, would the negotiation between China and the US yield a quick resolution of differences? Hello and welcome to Global Business Insights, where we look closer at some of the headlines moving markets and provide analysis and perspectives. US stocks rebounded as we got a spate of quarterly earnings reports, and hints at the de-escalation of US-China trade tensions led to a broad rally that boosted all three major US indices by more than 2%. Tesla announced first quarter earnings of 27 cents a share. Wall Street was looking for 36 cents. Sales were $19.3 billion in the quarter, also worse than the $20.1 billion that was expected. However, Q1 total gross margin beat analysts' estimates as sales in its more profitable segments, services and energy storage, registered strong growth, while electric vehicle sales dropped. Boeing is selling portions of its digital aviation solutions business, including navigation unit Jeppesen, to private equity firm Thoma Bravo for $10.55 billion. Boeing will, however, still retain the core digital capabilities to provide customers with fleet maintenance, diagnostics, and repair services. But our deep dive is on the ongoing IMF spring meetings. The International Monetary Fund has also restated the importance of central bank independence, as chief economist Gorin Charles told reporters that the IMF now views recession odds at 40%, up from 25% in October 2024. That's in the United States of America. The IMF also projected that Nigeria's economy will grow by 3% in 2025 and a 2.7% growth rate in 2026. It reiterated the familiar theme that while Nigeria faces significant challenges, particularly with inflation, forex volatility, and weak infrastructure, recent policy adjustments such as the partial unification of exchange rates and removal of fuel subsidies could enhance investor confidence and stimulate economic activity if properly implemented.
The landscape has changed since our last World Economic Outlook update in January. We're entering a new era as the global economic system that has operated for the last 80 years is being reset. Since late January, many tariff announcements have been made, culminating on April 2nd with near universal levies from the United States and counter-responses from some trading partners. The US effective tariff rate has surged past levels reached more than 100 years ago, while tariff rates on the US have also increased. Beyond the abrupt increase in tariffs, the surge in policy uncertainty is a major driver of the economic outlook. If sustained, the increase in trade tensions and uncertainty will slow global growth significantly. Reflecting this complexity, our report presents a reference forecast which incorporates policy announcements up to April 4 by the US and trading partners. Under these reference forecasts, global growth will reach 2.8% this year and 3% next year, a cumulative downgrade of about 0.8 percentage point relative to our January 2025 WEO update. Our report also offers a range of forecasts under different policy assumptions. Under an alternative path that excludes the April tariff announcements, global growth would have seen only a modest downgrade to 3.2% this year. We also use a model-based forecast to incorporate the temporary suspension of most tariffs announced on April 9, together with the increase in bilateral tariffs between China and the US to prohibitive levels. This pause, even if extended permanently, delivers a similar growth outlook as our reference forecast, 2.8%, even if some highly tariffed countries could benefit. Now, while global growth remains well above recession levels, all regions are negatively impacted this year and next. And the global disinflation process continues, but at a slower pace, with inflation revised up by 0.1 percentage point in both years. These trade tensions will greatly impact global trade. We project that global trade growth will be more than cut in half from 3.8% last year to 1.7% this year. The tariffs will play out differently in different countries. For the United States, the tariffs represent a supply shock that reduces productivity and output permanently and increases price pressures temporarily. This adds to an already weakening outlook and leads us to revise growth down by 0.9 percentage point to 1.8%, with a 0.4 percentage point downgrade from the tariffs only, while inflation is revised upwards. For trading partners, tariffs act mostly as a negative external demand shock, weakening activity and prices, even if some countries could benefit from trade diversion. This is why we have lowered our China growth forecast this year to 4%, while inflation is revised down by 0.8 percentage point, increasing deflationary pressures. All countries are negatively affected by the surge in trade policy uncertainty as businesses cut purchases and investment while financial institutions reassess their borrowers' exposure. Uncertainty also increases because of the complex sectoral disruptions that tariffs could cause up and down supply chains, as we saw during the pandemic. The effect of these shocks on exchange rates is complex. The tariffs could appreciate the US dollar, as in previous episodes. However, greater policy uncertainty, lower US growth prospects, and an adjustment in the global demand for dollar assets are weighing down on the dollar. Risks to the global economy have increased and are firmly to the downside. First, while we are not projecting a global downturn, the risk it may happen this year have increased substantially from 17% projected back in October to 30% now. An escalation of trade tensions would further depress growth. Financial conditions could also tighten as markets react negatively to diminished growth prospects and increased uncertainty. On the flip side, growth prospects could immediately improve if countries ease from their current trade policy stance and promote a new, clear, and stable trade environment. Addressing domestic imbalances can also help raise growth while contributing significantly to closing external imbalances. For Europe, this means spending more on public infrastructure to accelerate productivity growth. For China, it means boosting support for domestic demand, while for the US, it means stepping up fiscal consolidation. Turning to policies, our recommendations call for prudence and improved collaboration. Let me outline some key ones. First, an obvious priority is to restore trade policy stability. The global economy needs a clear, stable, and predictable trading environment, one that addresses some of the long-standing gaps in international trading rules. Monetary policy will need to remain agile and respond by tightening where inflation pressures re-emerge while easing where weak demand dominates. Monetary policy credibility will be key, especially where inflation expectations might de-anchor, and central bank independence remains a cornerstone. Many fiscal authorities will face new spending needs to bolster defense spending or to offset the trade dislocations likely to come. Some of the poorest countries, also hit with reduced official aid, could experience that distress. Yet, debt levels are still elevated, and most countries still need to rebuild fiscal space, including by implementing structural reforms.
Allow me to share some observations. I have listened carefully to IMF economic briefings for over 10 years consistently, and there are hot buttons that always seem to recur, and some just given a slight mention. The IMF perspective has been very useful in applying a robust template to help economies make economic progress, but economic outcomes, especially of late, have been particularly tepid. You have to wonder if the prescription is working. Also, first, today's world is transitioning faster from resource-based economies away from even efficient economies to a vastly different digital and intelligent age. Like I said in an earlier chat, the advantage of skilled cheap labor that helped the rise of offshoring to Asian tigers is yielding to a new type of advantage driven by data, energy to drive artificial intelligence, data centers, and a very different level of automation. Countries held back by energy poverty for whatever reason, with poor data management disciplines and scanty digital infrastructure, are going to struggle. And these struggles will mean much wider scale of income inequality, poverty, and vulnerability. And that is putting it lightly. The second observation uses the familiar boiling frog metaphor, where a frog with a body able to detect temperature is put in a pot of water under a gas fire. The frog initially is comforted by the warmth as the water heats up, then adjusts to the temperature, then finds it needs perhaps a nap and shuts its eyes only to be cooked to death. The frog can jump out of the pot but does not. Measuring GDP, stock index parameters, and adjusting to a simmering volatility can mean we are missing what we should really be more focused on, and that is social and income inequality, racial and gender inequity, unparalleled toxicity of political divisions, and an unabating poverty driving immigration and social pressures. These are the gas fires under the pot as we see the IMF, and rightly so, helping the world to adjust to its temperature measurements, but paying less attention to the burning flames boiling the frog to death. IMF does what it knows how to do best, to forecast, measure, and advise on adjustments to economic well-being based on its forecast. It has little choice but to conclude that the metrics that served it well decades ago will have to do. Thirdly, everything tends to fall on leadership and execution as leaders leave meetings like the IMF spring meetings armed with what to do, but face barriers like corruption that the IMF is too polite to raise. The level of illicit capital going to the West from South economies is not just high. Western economies have unconsciously become addicted to it. Eventually, the IMF template sounds like a scratched record as execution lags badly. Indeed, there is no need for pessimism. After all, the world will adjust, as it always does, to the new tariff regime, to a more unilateral America, but MAGA is not the last geopolitical surprise that will jolt the calm inside the different boiling pots that delegates will be returning to. There is need not just for better answers, but also for better questions. Asia Pacific markets up, tracking key benchmarks on Wall Street after Trump said 145% tariffs on goods from China would eventually drop substantially, adding that there are no plans to fire Powell. Alphabet is set to release results tomorrow, while IBM and Texas Instruments will report today. Well, that's all on this special episode of Global Business Insights. Thanks for watching. This is Bode Oshosani. Bye-bye.